Well, welcome back to You Heard It From the CFP. My name is Matthew Coyle. Today is August 9th, 2021. Thank you so much for watching. And today we're going to do a good old-fashioned market update because it's almost vacation time, and who wants to think about the markets during vacation? We're going to do this before vacation. So, I've got my dog here, I've got my charts, I've got my laptop. Let's dive in. Charts here. I'm just going to go through this pretty casually and talk about what's going on in the market and kind of what we're looking at. It's almost vacation time. I'm sure most of you are turning your thoughts to that and not necessarily to what's going on in your portfolios, but some interesting stuff going on there. Maybe some turning points we're seeing in the economy a little bit to talk about too. So number one, let's start with the S&P 500. That is, of course, the largest 500 publicly traded stocks in the U.S., or at least most of them. And it's probably the most widely followed proxy as far as growth stocks in the U.S. So we'll start there, up about 18% year to date on the year. So if you're only in that particular index, you've had a very nice year. Most of my clients are not only in that particular index, and you probably aren't either. But it's a proxy for growth stocks, and of course, it's been a very good year. 2021 has turned out to be a very good year for equity investors, as in general it's been. How's that made up? We'll go to the sector performance as of the moment here. So as of August 6th, again, strangely enough, energy leading the way, coming off a pretty low bottom, of course, after last year's debacle. So, but of course, energy, not surprising that it would be leading the way, although it's coming off a pretty severe bottom. Now, of course, from there it breaks down during a number of sectors there. Throughout the year, we've seen some pretty decent performance. Financials up 28%, healthcare up 17%, even utilities up 7%. Strangely enough, year to date. So, as rates continue to stay low, I guess not shocking that utilities and healthcare and consumer staples like that would do fairly well. So overall, pretty good year for the market. Buying continues to come into the market. If you look at something very interesting here, that we look at the market internals. This is a chart I was looking at the other day that I thought was just very, very interesting. This comes from the Morgan Stanley, JP Morgan, Guide to the Markets 2021, which came out late July. This particular chart shows you the price to earnings ratio on companies in the top 10 of the S&P 500 versus the bottom 490. So the top 10 average PE 29.5 on the top 10 versus barely 19 on the rest of the index. So kind of interesting there versus historical average 19 in the top 10 versus 15 in the remaining 490. Very, very interesting dichotomy, kind of breakup going there. So the market is really being led by 10 or 15 large company stocks, as it has been for the last few years. So very interesting chart there. I thought that was interesting to note. Next one is the number of days. I like to look at this from time to time and just go over how many days in the market have we seen that move up or down by 1%. A lot of people watch that in the market to try and pick out various inflection points as to where traders might want to be or not be in the market. So it's been a relatively quiet year this year. We have not had many days up or down by 1% compared to previous years. Certainly nothing out of the norm. So fairly steady year thus far. We haven't had a lot of movement. Next chart, if you want to back up to 2012 in the same index, the S&P 500, buying just continues to support the market. It's just been a very, very, very solid equity market since 2012. Of course, March of 2020, we had the coronavirus crash that righted the ship fairly quickly, and we've had a fairly hospitable market since then. So buying continues to come in the market. So let's look at world markets in 2021. And what you're looking at here is year-to-date world markets across the globe, everything from the US to France to Japan to Germany to China, everywhere. France, surprisingly enough, continues to lead the way in 2021. Again, if you predicted that at the beginning of the year, you're a heck of a lot smarter than I am. So France continues to lead the way. S&P 500 is next, and all the way down to the Chinese and Hong Kong markets, which are struggling at the moment. But very interesting dichotomy there going on. The U.S. just continues to lead the way for the most part. Okay, let's look at some fixed income bond market events going on. Interest rates in particular. Interest rates and the bond markets are far larger than the stock market. The stock market tends to get all the publicity and the headlines. But what goes on in the interest rate markets and the bond markets is far more important to the world and far more important to what you and I do on a daily basis. Strangely enough, you think of stocks as the most important thing. They're not. Bonds and rates are far more important. So let's look at what's going on there, and perhaps a couple things that we've noticed and just kind of interesting to note in the market of recent. So we'll start off with Treasury yields. These are yields on everything from 30-year bonds all the way down to 3-month bills. This is, of course, government obligations, government bonds that pay. And, this inflation fears that started to creep into the market, roughly about 3-4 months ago, and everybody was very worried about inflation and what yields are going to do and what that would mean for the market. That rally in yields really kind of fizzled out. So there's been a bid put to the bond markets. Now people have come back in the markets. The Fed has also come back in the markets and has been buying bonds, which has pushed yields down. And that rally in yields kind of has fizzled out a little bit, which is very interesting. And more specifically, and it's been across all the entire yield curve. If you go more specifically to the 10-year bond, and this might be the most important fixed income instrument in the world. It is probably the most quoted as far as the yield in the U.S. and certainly worldwide is watched very closely. So the 10-year bond affects everything from car loans to credit card rates to mortgage rates to pretty much everything you pay. And we are seeing yields come back down, or returns, I shouldn't say returns, yields on 10-year notes coming down, which is very important for consumers. This is a very, as I said, a very widely watched number, and we watch it very, very closely. Of course, it was a 0.5% yield back in August of last year. Since then, a year later, we've moved up since, and those were historic lows. But we're currently much less than people were forecasting we might be even a month from now. So it's nice to see that yields have come back down a little bit. That means rates on loans and things and mortgages have also stayed fairly steady. So that leads me to my next chart, which of course is existing home sales. Now I watch this one really closely because if you have more homes sold, there's more lumber sold, there's more furniture sold, there's more lots of things that are sold. Existing home sales, you could argue we've seen the peak for the summer. That might be a fairly astute observation to make. Both pending sales and existing home sales have actually occurred. They're both down since the peak here in late July. And this is, I think, actually the third straight month now of existing home sales that were down month over month. So we may have seen a peak for the year in home sales, and that might be a good thing. This market was running away with itself a little bit, and perhaps it's a good thing that we're seeing things moderate a little bit. So interesting to see there. Next one, and I've talked about this on these videos before. I do watch car sales quite a bit. Obviously, cars have a lot of inputs. They're heavily labor intensive to build, and they are sometimes a gauge for how the economy is doing. And car companies sell a lot of cars every year, millions and millions of them. And this, of course, is used vehicle chart, used vehicle cars, which you're looking at here. But the used vehicle market has become even stranger than the new vehicle market over the past 6 to 8 months. I've talked about it in these videos before. We may have seen a top in used car vehicle sales. We've seen a couple, 2-3 months now of prices coming down, and this may indicate a top for prices, and perhaps interest rates are having something to do with this. I don't know, but very interesting that the price in used cars now seems to not only have moderated, but it's starting to come down a bit. So I thought that was very interesting, and that leads me to my next chart, retail sales. Retail sales are increasing again, which is great. We want to see the economic activity pick up again and people getting back to work. So it's nice to see retail sales up again, and that leads me to my final chart, which is actually unemployment. So this all kind of feeds into how many people are working, how many people are looking for jobs. We are basically back, as far as unemployment, to the levels we were back in pre-pandemic. Now, it doesn't, of course, make it feel better for someone who's looking for a job. I understand that. But we have come down quite a bit on unemployment claims. Unemployment claims were not as bad as we thought they would be this past month. They've definitely come down, and we are back at levels which you could say are a fairly healthy range. And of course, that will probably continue to improve, I would suspect, given we don't have any more lockdowns or such. But so that's a very interesting chart to note as well. So some very interesting things going on in the economy and in the markets. I hope you've enjoyed this video. I also hope you are, if you're on vacation, I hope you're having a good time. If you're about to go, I hope you have a really good time. I will see you next week back with a whole different topic. And thanks again for watching. Take care.